Hello and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we're very pleased you have joined us for our Financial Services Conference. Our next presentation of the day is from BTCS. Please note you may submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for a one-on-one meeting by clicking Book a Meeting in the top toolbar. At this point, I'm very pleased to welcome Charles Allen, Chief Executive Officer and Chairman of the Board of BTCS, which trades on the NASDAQ under the symbol BTCS. Welcome back, Charles.
Great, thank you so much for having me. So let's get started. We'll just take a quick pause, let everybody look at the safe harbor. And I just want to give a shout out to OTC Markets before I begin the BTCS presentation. We were previously listed there and have been able to, in 2021, grew substantially and were able to uplist to the NASDAQ, but it's a amazing platform for earlier stage companies. So I just wanted to mention that before we dig into the value proposition of BTCS. So BTCS stands for Blockchain Technology Consensus Solutions. We've been public since 2014. And we are executing a DeFi, TradFi financial model and flywheel to grow operations around Ethereum on the infrastructure side. As I mentioned, we're the oldest public company, and we've had many firsts in the public markets within the crypto space. For those not familiar with Ethereum, it's the #2 blockchain in the world, and it is really the foundation of the future of finance as we know it. Just taking a step back, the internet in early 2000 allowed for the digitization of information, the proliferation of that information on a global scale. What the internet did not allow for is the tokenization of movement of assets without a trusted third party. And that's what we're seeing today with blockchain technology, primarily powered by Ethereum, where you can tokenize real world assets and move those on a global scale around the world without a trusted third party. With the backdrop of a new administration that is crypto friendly, the SEC allowing for innovation to happen within the US, the stage is really set for the future of finance and for the rails of how digital assets or how assets are represented and moved around the world. So if you want to get exposure to Ethereum, there's really only a couple ways at the current state. One is you can, obviously you can go own the token yourself, but if you want to do it through a public wrapper, you can own an ETF, which just gives you one-to-one exposure, net of fees. The next kind of phase up is you can move to a lot of these digital asset treasury companies, many of which have recently just emerged in the last 3 to 4 months, and they're primarily staking their tokens, and that's the main business. And then you can kind of move to BTCS. So we've been in the blockchain infrastructure space since 2014, and we've been focused on Ethereum's infrastructure since 2021. And we have vertically integrated operations, both running our own validator nodes, which are basically securing the transactions that occur on Ethereum's blockchain. And we've got a unique DeFi, TradFi capital formation strategy. So those are the things that really set us apart from many of the other more recent digital asset treasury companies. And so now I'm going to dig into a little bit of how that works. And so we basically, to kind of simplify what our business does, on the left we have operations, in the right we have our capital formation strategy. And so from an operation standpoint, we have under blockchain infrastructure node ops, which is the staking of our tokens. So we take our Ethereum, we run validator nodes and stake our ETH to those nodes and generate returns for doing that. And we're also a block builder where we build blocks for the Ethereum ecosystem. In order to do that, we're basically looking to grow our stock price and drive revenue through strategic capital raises to drive accumulation of ETH through revenue generation. So moving through how that works. On the revenue generation side, I talked about Builder Plus, which is our block building operation, and Node Ops. So at a high level, without getting into the technicals of how this works, Node Ops is very high margin. It's well north of 90% and with a lot of room for margin improvement. But the ability to grow that revenue requires a high amount of capital deployment, whereas Builder Plus does not need a lot of capital to grow it. And that's where our focus has been. Right now, we account for anywhere between 1% to 3% of all transactions that occur on Ethereum's blockchain, which also includes all the L2s. And so you can see what that's done to our quarterly revenue growth over the last year. In Q2 of the past year, about 80% of our revenue was through Builder Plus, our block building operation, about 20% through Node Ops. And we're year to date, we're about, through Q2 this year, about 4.5 million in revenue. And just taking a historical look at this, in 2023, we were about 1.4 million in revenue. 2024, we're 4 million in revenue. And the 6 months to date, we're at about 4.5 million. So we've had substantial growth in revenue. And kind of moving along in terms of how this actually works. The Node Ops, as I mentioned, was staking, so it's equivalent to earning a yield on the digital assets that are put up as effectively collateral to be able to run the validator nodes. And the block building is a little bit more complex, where we basically buy block space from validators, and that's our cost of sales. And any transactions that want to end up on chain, if we can include those transactions, we get all of the fees. So if you think about this from an equity market standpoint, we're basically like kind of buying order flow, and we get all of the trade commissions. And I know those don't really exist anymore, but we get all the trade commissions for organizing trades into a block that get settled. In terms of our growth strategy on the operational side, we are really looking at three prongs. One is through technological improvements. The other is to increase high value order flow. And the last is to control block space. And in order to do that, we've made some substantial integrations and partnerships with some leading companies within the blockchain ecosystem. In terms of our market cap and stock price, because that's obviously what investors typically care most about. Obviously, we're in the crypto space, so our stock is very volatile. But if you zoom out just a little bit, you'll see we've grown our company, both the market cap from 2022 to where we are in 2025, substantially. So we're about a 221 million market cap as of this reporting, and that's about right for where the stock price is today. We have north of 300 million in assets in crypto. So there's a bit of a dislocation in the market today, which is why we're actually doing a stock buyback, and we're paying a dividend. So the record date for anyone that's interested on the dividend is tomorrow. In terms of how we raise capital, I think this is probably one of the most important things that a public company needs to focus on, is to make sure that they protect their shareholders, especially their retail holders, and do accretive financings and do it in structures that truly benefit shareholders. So we have a three-pronged approach. We have an at-the-market financing facility that's in place. Year to date, we've raised approximately $140 million off that ATM. We also have issued $17 million in convertible notes through an agreement with ATW, where we can raise up to $50 million. And all of those notes have been done above market. So the last one we did, the note converts at 13%, and we issued warrants, $13 a share, and we issued warrants that convert at $8 a share. And I think the stock was about $6 when we did this deal. So it's about a 42% savings on an as converted basis compared to using the at-the-market offering. And the last one, and this is what this slide really focuses on, is we've been borrowing on Aave, which is a decentralized lending and borrowing protocol. It's truly amazing. I think it's going to revolutionize how finance works. But we've been able to borrow just north of $50 million, and we've put up as collateral our Ethereum in order to do that, which is about 38,000, which at the time of this reporting is about 125 million. It's up substantially since then. But we earn interest on the collateral, which is really interesting. So we earn about ballpark 2% on the money we put up. We're paying ballpark about 5.5–6% on what we've borrowed, and that's USDT. So that's in dollar terms, whereas the interest is in ETH. And if we deploy what we've borrowed and earn just, conservative numbers, 3%, it means we're making basically on this math, and these are variable interest rates, approximately 1% on our money, which doesn't seem like much, but we've increased our exposure to Ethereum by an additional 42%, which is huge because we've been buying ETH and accumulating it at lower prices than where they are today. So this is really a unique model. This can literally be done in under a couple minutes. There's no paperwork, there's no underwriting fees, there's no banking fees, there's no right of first refusals. It's truly amazing. And I think right now we're the only public company marrying both DeFi with traditional financial tactics to raise capital in a cost-effective way. Looking at kind of our balance sheet in terms of ETH, we've had substantial growth. In Q3, as I mentioned, we raised close to $200 million. Our ETH has grown to over 70,000, and this has really been recently. So, if you're reading our financial statements, which is going to be the next slide, they're pretty much outdated at this point. I would say they're stale. Like the 6 months ended 2025, we had 40 million in total assets. We've raised near substantial capital since then, and that capital has been deployed in Q3. So I think we're most excited for Q4, where we'll really see these numbers come to fruition in terms of driving revenue growth, as well as adjusted EBITDA as well, which is a metric we plan to start disclosing. So moving along, I think just looking at our cap table, we have did that move? We have a very clean cap table. So it's basically we have common shares. As I mentioned, we have a $50 million buyback, so I can't give an update to where we are today, but we have been buying back shares. As of this report in August, we had about 48 million shares of common stock outstanding. We have the two convertible notes, the $7 million one that has a conversion price of $5.85 and a $10 million note with the $13 conversion price, as well as we have warrants. They're all out of the money. We've filed a registration statement covering both the warrants and the convertible notes to make sure that there will not be additional dilution through cashless exercise provisions. And we have, I guess the last warrant is we have one at 11.50. So it's a very clean cap structure. We do have some preferred stock, but it's non-convertible, and it isn't the board could theoretically convert it, but we can't do that for about a year, and there's no additional preferences. It's equivalent to common stock. We have very high insider ownership percentage. I think I own close to 10% of the company at this point. So, I spent a decent amount of time on the cap table. I think it's really important to go over that so investors understand that there's not, toxic features or other things in there that could really create issues. We also didn't do, like many of our competitors, like a big pipe financing, which I think is really unique. A lot of the more recent deals have done very large pipe financings, and when those shares become unlocked, the stocks tank down anywhere from 80 and 90%. We're the oldest public crypto company in the world. We've been focused on the strategy since 2021, and we've kept our cap table very clean to ensure that there aren't these huge spikes in volatility that are not associated with the normal market conditions, that are associated with huge slugs of equity coming to market. Moving along to the team, we're a very small team. We're about seven employees at this juncture. We have an amazing board of directors. We have Charlie Lee, for some who may not know, he created Litecoin, used to be at Coinbase. We have Melanie, who's deep in the cryptocurrency space, and we have Ashley, who is the chief marketing officer at Clear Street, one of the a very large investment bank, and then Michael, who is one of the co-founders of the company. And so I guess I'm doing pretty well on time. I've tried to go fast, but I do want to leave time for questions. And so just the key takeaways, if you're looking for exposure to Ethereum and its growth potential, we are the oldest public play in that space. We're the only ones with deep operations at the moment because we've been doing this for years, not months. And we're really looking to what I would call, not bet the horse at the racetrack, but kind of own the racetrack. So as long as Ethereum is the leading blockchain used for the tokenization of real world assets, I think we're in a very compelling place to have high growth. And so with that said, I'm definitely ending on the earlier side, but I'll move to, it looks like there's a bunch of questions. I'll start addressing some of the questions. So I guess the first is, how does BTCS vertically integrate ETH accumulation strategy given an edge over public companies? So what we're doing, and I'll jump back to, this slide, is we have node ops, which is running validator nodes. Because we do that ourselves, we're able to vertically integrate with our block builder. And most of the other digital asset treasury plays at this juncture are outsourcing their node, their staking to third parties, whether that's Blockdaemon or Figment or Galaxy. And so they're just effectively giving that ETH up for someone else to manage, and they're paying a fee. So the cost to a staking as a service provider can run anywhere from 5 to 10% of the rewards you earn. We run our own validator nodes, and so for us, there's no commission-based fee on the revenue we earn from those operations. It's rather our cost of sales is a fixed cost, and so that does one thing. It should give us a higher revenue for the validators we're running. And two, we also run validator nodes for Rocket Pool, which allows us to, through their liquid staking protocol, have it's anywhere from 30 to 40% increase in our revenue versus solo staking. And so that's something that other players aren't doing. We're also block building, and we're vertically integrated with our block builder and our node ops on the Rocket Pool side, which allows us to further increase revenue. And so these are the things that, these take a lot of time. We've been running validator nodes for close to 5 years now, and have been a block builder for about 2 years now. So I think that addresses what makes BTCS the most sophisticated Ethereum play. Let's see. So the next question is, with over 70,000 ETH in your treasury as of August, what policies are in place to safeguard these assets and manage portfolio risk and potential crypto market volatility? So I think that's a twofold question. One is, safeguarding these assets, and I think that more of on the cybersecurity. I hope that was the question. And so we don't use a third-party custodian. We self-custody the assets. We're using a multi-sig or MPC wallet provider that allows for all of the basic and advanced features that you would expect with a proper corporate governance, multiple signers for various transactions, and so it's a very robust system that we've set up, and I think that kind of addresses how do we safeguard them. In terms of volatility, we've looked at, could we hedge around the price of ETH at this juncture? It's not something we're doing. The hedging is too expensive. We had looked at it in the past, and the challenges with hedging was the cost to hedge was cost prohibitive, and we are long ETH. We believe that where ETH is going to go in the long term is up. So that's, we're just going to, volatility is just going to be a bit of the nature of our company. So let me go to the next question. We did the vertical. So as far as the main public competitors and what makes us the most sophisticated, most of the other competitors are not into their operations yet. So one is SharpLink Gaming, which is led as Joseph Lubin's the chairman there. I think what they're doing is great, but right now it seems like their operations are limited to staking. I'm sure they're going to make other efforts. Bitminer would be another one. They have substantially more capital than we have. It's unclear what they're doing beyond staking, and they've made some other investments into other DATs. And then Bit Digital recently pivoted out of Bitcoin mining into an Ethereum treasury. So I think what differentiates us, and I know I've touched on this, is we have a long history of operations and we're more focused on the infrastructure. I would also note that unlike Bitcoin digital asset treasuries, there's so much more that you can do. Ethereum is a whole digital economy with all sorts of revenue streams and opportunities within that economy to focus on. I think what you'll see with a lot of these digital asset companies that are coming to market, over time, they're going to start growing out and building businesses that are going to drive scalable revenue. Right now, we're the first to do that, and so the competitors' markets are really looking at, deploying their ETH, and then I'm sure they'll get smarter. I don't know where they'll actually focus in the long run, but it's this is a very big market with lots of opportunity. So I don't think it's a zero-sum game. Let's see the next question. The presentation highlights partnerships with ETHCast, MetaMask, Rocket Pool, and others. How are these relationships expected to drive future growth and revenue scalability? So each of those different partnerships is different. They kind of fall into three buckets of either technical improvements, increasing our order flow, or controlling block space. So for Rocket Pool, by vertically integrating, we're basically controlling block space, which gives us access to more revenue generation. ETHCast, we're actually an investor in ETHCast. We invested $250,000 into them. Not a huge investment, but it allowed us to be a priority builder. So that's driving additional revenue because we get order flow that we would otherwise not have access to, and it's really helping scale Ethereum. And then MetaMask, we just get their order flow. So that helps us be more competitive in terms of the gas fees we can earn with the block building. Let me just see what other questions. Okay, so how do you evaluate recent regulatory developments such as the Genius Act, stablecoin framework, and the SEC stance on ETH, and what impact do you expect these to have on BTCS' business model? A great question. It's night and day. We've been public for approximately 11 years. The last 10 years has been brutal dealing with the SEC in terms of trying to get registration statements effective. They would stonewall us. We went in and asked questions from the crypto office hub that was supposed to be set up so you could ask questions and get clarity. The second we did that, they turned around and subpoenaed us and started a formal investigation that we were a broker dealer and we were a 40 Act company and all these things, basically in response to the questions we asked. So what we've seen in this year has just been phenomenal, right? The SEC is taking a pro-innovation, pro-crypto approach. The administration has put together the Genius Act, which is a stablecoin framework, and it's a bipartisan, which is now law. There's the market, was it FIT 21, I think, is the Market Integrity Act, which has been passed by the House. It's being looked at by the Senate. And so I think as the regulatory landscape improves to allow for innovation within the US and to embrace blockchain technology, there's going to be a huge amount of capital that's going to flow into the market from large institutions. We're starting to see that happen with BlackRock and Fidelity. And as that occurs and the rules of the road get defined, I think this market is going to grow substantially. And so what does that do to our business model? If you look at what we've done this year, we've raised north of $200 million, primarily in this quarter. We've grown our balance sheet from about having, fluctuating between 25 and 30 million, depending on the price of cryptos, to being north of 300. So, we're at a real inflection point for BTCS in that we've kind of hit scale. I mean, I'd love to be a multi-billion-dollar company, but going from a 30 to $40 million company to a 300 million plus in assets. I know the market cap's only around 200, but that's been and I don't think any of this would have happened had we had not had a a change in administration and a change in view by the SEC, which has allowed capital to flow in. BTC combines DeFi borrowing with traditional capital formation. What are the specific risks and reward of this approach for shareholders? So I think it's beneficial. It's obviously, we believe it's highly beneficial for shareholders. So on the DeFi borrowing side, when we borrow, it is a perpetual loan with a variable interest rate. And so what that means is we never have to pay it back. We only have to pay it back when we want to extract our collateral, and all the interest just accrues. So if we buy, and I'll use round numbers, if we have 100 million of collateral that's put up and we borrow 30 million against that, the value of the collateral, if that's Ethereum and it goes up to go from 100 to 200 million, our loan to value ratio will have gotten cut in half. So if we were in that example with 100 million and 30, our loan to value would be 15 million. But if we deploy that to buy more ETH, which we do, and then stake it, it means we've basically taken on leverage with a very low cost, and it's got a net positive, or can, depending on interest rates at the particular time, could be a net positive yield, which is remarkable. The risk is if the price of Ethereum falls and it falls below a liquidation point for our collateral will start getting liquidated to pay off the loan. And what that liquidation price is, as of August, I'm gonna keep these dates, and at a fixed point, it was about $1,800 per ETH. So if Ethereum gets more than cut in half, and we didn't take any corrective action to repay or put up more collateral, we could theoretically get liquidated, but that's just our ETH would get sold off to satisfy the loan. So we've done it, the board's only authorized management to borrow up to, have a loan to value ratio of 40%, which we think is conservative. And we've managed to, we're actually below that. So it gives us access to capital without diluting our shareholders, giving exposure and allowing us to grow the business. And I think that's really unique. And to be able to do that in mere minutes is remarkable. So I think it looks like that I think that was the last, let me just see. I think that's the last. I got all the questions. Let me just take one more look here. No, actually, I missed one entirely. So what role does your staker protection plan play in differentiating BTCS from other validators, infrastructure providers? So basically, we launched the staker protection plan as a way to allow other validator nodes to pre-sell their block space to us. And so it works very well for us when you're vertically integrated with a block builder. If we can pre-purchase block space from a validator, it goes back to controlling block space. So in order to control the block space by running a validator, you have to post the ETH you basically have to stake that ETH. If we do it through Rocket Pool, it's a liquid staking provider. We get a lot of leverage on that staking in that other people are putting up the capital. There's no additional risk to us from a staking perspective. And what the staking protection plan does is it gives the actual validator smooth earnings and allows us to pre-purchase that block space. So that was really going back to those three key caveats of controlling block space, increasing order flow, and technology improvements. The staker protection plan is geared at allowing us to control more block space without additional capital. And I think I'm at the 29-minute mark and counting. So at this point, I'll just wrap it up. And I want to thank everybody for their time and listening to this presentation. If anyone has follow-up questions, you can email us at ir@btcs.com. There's more information at btcs.com as well. You should also follow us on X. You can it's NASDAQ at NASDAQ at BTCS, or you can follow me as well. That's the official distribution channel for the company. So again, thank you for your time and listening to this presentation. And we're open to take questions in the future or set up one-on-ones if there's an interest.